Hi everyone. So welcome to the live stream today. My name is Nhyira Premium, and in case this is the first day you are joining us on the live stream, I'm really excited to have you as you join us as we continue with our discussion towards the August 2022 examination. And we are discussing the IAS 7, that is cash flow statements. And we did the part one on Monday. In case you missed that, you can check the description of this video on YouTube and you can watch the part one of that so that you build up with us in the part two so you understand exactly what we need to look out for. Now, preparation of the cash flow statement is one of the fundamental issues that you need to understand when it comes to preparation of the final accounts in financial reporting. However, the knowledge of cash flow statement is also crucial for those of you doing corporate reporting or advanced financial reporting. The reason is that you're going to be doing consolidated cash flow statements. However, before you can look at the consolidated cash flow statements, the fundamentals are required in financial reporting. And so that is why we want to continue with our discussion on that today. Look at the various discussions that must be had, and then the various things that we need to understand relating to these things so that we can really go into some questions as well and then have a full understanding of IAS 7 cash flow statements. I see some of you guys joining. You are welcome. Give us a thumbs up on the video when you join, and also remember to share the video. Let us reach as many students as possible. Together, assist a lot of students in the country, across the continent, because that is my objective. That is my goal for this live stream sessions, and also creating this channel and this platform so we can assist a lot of people, a lot of students who are in the same position and looking for quality study materials to help them to pass the examination. So let me know any questions for me. Give me a thumbs up on the video when you join us. Put in the chat box for me any questions you have, something you would want me to share my thought on. Put it in the chat box. I'll be excited to really answer your questions for you as well in the discussion. I see some of you coming up with some messages. I'm going to be reading your comments as we get excited into the discussion today and continue with the discussion on the cash flow statements. So we have what we got. Alberta Ekubia said, "Good evening, sir." Good evening, Alberta. I hope you're doing well. Ring Echo said, "Thanks. Always a pleasure." Israel Som said, "Good evening, Shira. Hope you are doing good." Yes, Israel, I'm flourishing and I hope you are also doing well. Sovik Sarinji said, "Thumbs up." Thank you, Sovik, for joining us on the stream today. Eric Ahiadeki said, "Good boss, you are doing a great work." Thank you for that. We really appreciate your support. You guys make it possible for us to be able to come on these streams and also assist you with some of the things that we are doing here. Ring Echo said, "Greetings, dear." Greetings, Ring. Thanks for joining us on the stream today. Any questions for me, please put it in the chat or the comment section for me. I'm going to be reading all your comments and assisting you with everything that you are having or challenges with, so we can get excited into our discussion today. So remember, you can download the Nhyira Premium mobile application on the Google Play Store or the App Store. It gives you access to some exclusive video contents that are not available even on YouTube or our other platforms. And also you get access to some posts and notes to enable you to prepare well for the examination. So you can download the Nhyira Premium mobile application on the Google Play Store or the App Store. That way you will be able to study under my mentorship as well, so we can assist you to prepare well for the examination. So let me bring my screen up. On Monday in the part one, we started with a couple of discussions. So I want to bring my screen up and then we can continue with where we left on Monday in the part one and see what we can add on today in the discussion. So my screen is coming up. We're going to do a quick rundown. Then we're going to get excited about our discussion today. Now, if you remember in the part one on Monday, what we discussed was that we mentioned generally that the reason why we are preparing a cash flow statement is because we want to reconcile the statement of profit or loss, the profit for the year, with the statement of financial position, that is the cash and cash equivalent balance on the face of the statement of financial position. Now, the reason is that we said that sometimes an entity makes a profit of, say, 10,000, but then the cash and cash equivalent on the face of the statement of financial position is just $1,500. However, shareholders are like, why is that the issue? Why do we declare profit, a huge amount of profit, but there is less cash available? The reason is that profit is not the same as cash. And so we went through a couple of reasons why there could be discrepancies between the profit for the year and the cash and cash equivalent balance on the face of the statement of financial position. And so we came up and we said that, hey, the cash flow statement is going to be prepared looking at three key activities: the operating activities, investing activities, and also financing activities. Most importantly, we said that the operating activities have to do with looking at the core activities or the core operations of the organization. We emphasize on the fact that there are three key issues that we're going to be looking out for when it comes to dealing with the operating activities or cash flow from operating activities. We said we're going to be looking at movement in the current assets of the organization, movement in the current liabilities of the organization, and also making various adjustments to the statement of profit or loss accounts. However, we said there are two methods that can be used in arriving at the net cash flow from operating activities. We have the direct method, where we're going to be looking at the actual cash flows that occurred during the year, and we will look at payments of wages and salaries, employee payments given paid to suppliers, interest that we paid during the year, tax that we paid during the year, receipts that we had during the year from our customers. These will be captured under the operating activities if we are looking at the direct method. But we emphasize on the fact that usually we're not going to be looking at the direct method when it comes to the preparation of the cash flow statement, but then we're going to be looking at the default method, which is the indirect method. So we emphasize on the fact that when it comes to the indirect method, we are going to be starting with a profit before tax for the year, and we will do the various adjustment that has to be made to the profit or loss, and we discuss that in detail in the part one. Like I said, in case you missed that, you can watch the video by checking the description of this video on YouTube, and then you can watch the part one, and then you follow up with us very well in the understanding. But we said there are a couple of workings that we would have to set ourselves up as we are doing the cash flow statement. One of the workings will be the interest that is paid during the year. That happens if, for instance, on the face of the statement of financial position, we have accruals of interest under current liabilities. If that is the case, then the interest charge for the year is going to be different from the interest paid for the year. And so we're going to prepare the interest accounts. Not only that, we could be asked also, or we need to also prepare the tax account. And in this case, we're going to be bringing the movement relating to the income tax, deferred tax account, as well as the current tax. And so the balancing figure will give us the tax that is paid for the year under review. But most importantly, we emphasized on the fact that when it comes to dealing with the tax, we are going to look at both issues relating to the OCI as well as the profit or loss for the period under review, because that is what will actually guide us to be able to prepare and do our workings for the period under review. Then we went to the next item, which is dividend. We went to the next item, which is dividend. Now, we said dividend can be arrived at two, or can be disclosed under two categories. We can put it under operating activities or put it under financing activity. Whichever place you put dividend, you're going to be okay. However, how do you calculate the dividend that has been paid for the year? You need to use the retained earnings account, and that will help you to know the balancing figure and the dividend that was paid for the year. However, one crucial or fundamental workings that we're going to be looking at is the property, plant, and equipment, so that we can either determine the property, plant, and equipment acquired during the year, or the depreciation during the year, or better still, know the various issues relating to the disposals during the year. So that was where we ended on in the part one. in our discussion on cash flow. So we want to build up straight up on that. If there are any questions, put it in the chat for me. I'm going to be answering all your questions. So put it in the chat for me. I am really going to be answering all your questions as we get excited about our discussion. Say, why do most of the organization prefer indirect method of cash flow than the direct method in their report? Yeah, because the indirect method is the realistic way of actually preparing your cash flow as an organization. Because when you are going to go with a direct method, it means you are going to go back to your journals. You have to look at prepare looking at you. So you are going back to the fundamentals, like looking at how much receipt did you have from customers, how much you paid to your suppliers, and that is unrealistic. So in that case, what we do is that we rather take ourselves to the profit before tax, then we can make the adjustment from the profit before tax, because that is more realistic and that's provide us with a reasonable treatment when it comes to arriving at the cash flow from operating activity. So that is why by default we prefer to go with the indirect method, even though the direct method can also be used. So it is because of the flow that what we are really looking out for is to reconcile the statement of profit or loss and the balance in the statement of financial position. So if you want to reconcile statement of profit or loss and the statement of financial position, then it will be prudent for you to start with figures coming in from the statement of profit or loss rather than figures in your journals, to be able to reach a reasonable conclusion on what exactly is happening. Then we go to the dividend, oh, sorry, property, plant, and equipment. So in the property, plant, and equipment, remember this is an asset, so it's going to be keeping a debit balance. Now, I want you to pay attention to me carefully because a lot of things will be coming up here. So you're going to bring the balance brought forward. That's usually going to be the opening balance. Then I'm going to pretend that we closing the accounts for the period and the review so that we bring the closing balance here. Then we're going to build in between what's happening in the property, plant, and equipment. Now, sometimes the entity may revalue assets. Okay, so when there is upward revaluation of assets, what does that mean? In other words, you're going to look at the other comprehensive income of the entity. If you look at the other comprehensive income in the statement of profit or loss and other comprehensive income, and you see that there is revaluation there and the figure is positive, that means during the year there was revaluation of assets. So when there is upward revaluation, that is going to be coming here. Okay, so during the year there was a revaluation surplus, it will come on the debit side. However, if also during the year they revalue the assets and it was a downward revaluation, then any revaluation or impairment loss, revaluation loss or impairment loss, maybe on the credit side, meaning the value of the asset is reducing for the period under review. And you could find revaluation loss also in the OCI sometimes, because we've discussed this already under IAS 16, so you know the implication of that. There are times when we can find revaluation loss in the OCI if it is revaluation loss coming from a previous asset that had been valued upward by the organization, right? So that is about revaluation. Then there are times during the year the entity may lease asset. Okay. So lease property, plant, and equipment may be brought on the debit side because it has increased the property, plant, and equipment for the year under review. So we bring it on the debit side. Okay, we bring it on the debit side for the period. Now, there are times also there could be transfer of assets into PPE. Okay, transfer of assets to PPE. For instance, as per IAS, maybe let me pull up something here. For instance, an investment property that the entity is using, the entity has changed it to property, plants, and equipment. Now, remember, investment properties are accounted for in accordance with IAS 40, investment property, but now they are changing it into property, plants, and equipment, and so should be accounted for as per IAS 16. So, if during the year the entity actually transferred any assets like that to PPE, then it has to come on the debit side. But then if they also transfer from PPE, because the same scenario may come in, that during the year the entity is having an owner occupied property, plant and equipment, but they decide to change it to an investment property, or decide to change it, de-recognize it as held for sale, then it has to be accounted for in accordance with IAS 40. So there could be transfer from PPE as well, and that will go to the credit side. Now remember, this is a pro forma, so I'm going to try as much as possible and then play all of the assumptions, scenarios that we can have. But then it depends on the question and what has to be included. But you have to know where what entry has to be made, or where what entry has to be located, in order for you to understand exactly what is going on. So they could be transferred to PPE, or they could be transferred from PPE. That could be done as well in that particular case. Then, in addition to having these, so we've brought revaluation, we've brought leases of assets, we've brought transfers relating to PPEs also during the year. Then sometimes there could be issues about, depreciation. I'm going to explain this to you in a moment, so stay with me. Depreciation always goes to the credit side for the PPE accounts in that case. Then we may be told that there was a disposal during the year. So we bring in the carrying amount of the asset dispose also on the credit side here. Then this account is going to be balanced. All right. Then we're going to be having the balancing figure probably being acquisition of PPE during the year. But I want you to stay with me carefully of this, because these three items, the acquisitions, okay, the disposal, and then the depreciation, these three items in your PPE account, when you're preparing your PPE account, you are likely to be looking for one of these three items. Please stay with me carefully. When you are preparing your PPE account, you are likely going to be looking for one of these three items. What does that mean? In other words, the examiner can tell us directly in the notes that during the year, the entity acquired X amount of PPEs. Then you put it on the debit side. During the year, depreciation charge was Y amount. You put it on the credit side. Then in that case, when you balance the account, the debit side will be more than the credit side. So then the balancing figure will become disposals of PPE, the carrying amount for the disposal of PPE. Or the examiner can say during the year depreciation was this, the entity did not dispose of any assets. Then in that case, when you balance the account, the credit side will be more than the debit side. So the balancing figure, which will be on the debit side, will be acquisition of PPEs. I hope that makes sense. So that is how the PPE accounts is going to be prepared. But like I said, this is just a pro forma and trying to make you understand the principles and how the various items are actually added together in general. But you will be looking for these three items, one of these three items in each question, and you have to be mindful of that. So that is also the PPE account. So when depreciation is not given, you figure it out. When disposal of assets is not given, you may have to figure it out. When you are not given acquisitions of PPE, you will have to figure it out. Now remember, this acquisition of PPE is going to go into investing activities, and we're going to get ourselves into that in a moment. That will go to investing activities. The current amount of the assets that we dispose of is not going to be going anywhere in our cash flow statement. It's not going to go anywhere in our cash flow statement, because we're not going to deal with that. It is the proceeds from the disposal that will go into the investing activities. That is what you must understand about the PPE accounts as well. Any questions, please? You put it in the chat for me or in the comment section for me, and I'm going to read all your questions and provide you with some answers as we continue with our discussion. So now that we've looked at the PPE and we've concluded on the issue relating to the cash flow from operating activities, let's crunch some numbers. Let's have some ideas about how cash flow from operating activities can actually be calculated, taking into consideration the direct method and the indirect method. Remember also that this whole discussions we are having, it's coming from our book on financial reporting and corporate reporting, no book on these two subjects, which was released just this year, uh, earlier this year, to enable students to prepare well for the examination. So all notes and all questions are actually going to be coming in from this book in that case. So I have an illustration here that we're going to be looking out for. Very simple illustration. And we're going to look at it and then see how we can actually solve a question relating to that. So this is an extract we have. Extract from the financial statements are as follows. So we have profit, we have investment income, we have finance cost coming in, we have profit before tax, we have tax, we have other comprehensive income also coming in for the period under review. Then there is current assets closing and opening. We're going to get into this, don't worry. Inventories, it's coming in, receivables coming in, trade payables is coming in. But there is an additional information. It says during the year, depreciation of 50,000 and amortization of 40,000 was charged to the profit or loss account. Receipts from customers combined with cash sales were 800,000. Payment to suppliers of raw material was 400,000. Other operating cash payments were 100,000, and cash paid on behalf and to employees was 126,000. Interest paid was 12,000. Tax paid was 13,000. So this is just an extract information given to us to enable us to look at what we need to do. So look at the requirements. A, it is using the direct method, prepare the operating activity session of the cash flow statement using the direct method. Now, remember, like we said earlier, when we are looking at the direct method, then our focus will be on the actual cash, the actual payments that we gave to people during the year under review. So let's look at how that is going to span out in the discussion. So, practice question. So, the A aspect of the question, we are preparing the cash flow statement using the direct method. Using the direct method. So remember, our focus here is on the operating activities. So that is our focus here, operating activities. So if we are in the operating activities and we are using the direct method, we're slashing our currency sign. Let's go back to the question. With direct method, it means we are looking at the actual cash we received during the year and the actual payments we made during the year. So that information is captured here. Okay. That information is captured here in the notes. So we're going to look at that information and use that information to our advantage in the preparation. So it says receipt from customers was 800,000. Okay. Combined with cash sales were 800,000. So we bring that coming in. So cash from customers, 800,000. Next one, it says payment to suppliers of raw material was 400,000. So we bring that up. Cash paid to suppliers, 400,000. Now that is payment. Money is going out of the business. So we put that in brackets. Okay. Next one, other operating cash payment were 100,000. You bring it up. Other operating cash payments. 100,000. That is also an outflow. Next one, cash paid on behalf and to employees, 126,000. So cash paid to employees. That's going to be coming up there. And that will be the issue relating to 126,000. So we bring it up. So we bring cash receipt from customers. We bring cash paid to suppliers, cash paid to the operating for operating payment, then payment to our suppliers. That is also a cash outflow. So we bring that up in that particular case. Then we're gonna get the net figure there, and that will be cash generated from operations. Cash generated from operations. And so we add that up, 800 minus 400 minus 100 minus 126, and that is 174,000. It's positive. 174,000. Then you bring in the interest paid and tax paid because these are actual cash flows. So these are directly given to us in the question. Interest is 12, tax is 13. So 12,000, 13,000. And so that gives us a net cash flow from operating activities. Net cash flow from operating activities. Sounds good. So let's do the maths. Minus this. That's 149,000. It's still positive. So that is how we deal with the cash flow from operating activities. Remember the direct method. So that's how the direct method is. That's how the direct method is. Very sweet, simple, straight to the point. You just look in and look at your actual cash flows for the period and the review, and then you look at it and then calculate it. You calculate it. But let's look at the second aspect of the question, and that is to look at the issues relating to the indirect method, still in the operating activities. So I'm going to pick this up here. And then put it here like this. So that's going to be B. And we are going to be using the indirect method. But we are still on the operating activities. So if we are using the indirect method, which is the default approach, sounds good, which is the default approach, then we're going to be starting with profit before tax, like we've said already. So profit before tax. So you go to the statement of profit or loss and pick your profit before tax. So our profit before tax is here. That is $82,000. So we bring that up, 82,000. Then we're going to bring in the various adjustments for the to the P&L account. So what adjustments must be brought? What adjustments must be brought? Go back to the financial statement. Look at it. Investment income. This is not something the organization does. So investment income will go into investing activities. All right. But it is here. So what are we going to do? We're going to, it was added. So we will subtract it. So investment income. So we're going to subtract it. That is an amount of 12,000 because it was added in arriving at profit for the year, profit before tax for the year. Next one, we see finance cost here. Remember the finance cost in the P&L must always be added back. Then probably the one paid is what we were going to work with. So we're going to add back this finance cost of 10,000. It was subtracted. So we will add it. 10,000. Next one. Was there any depreciation? Yes, there was depreciation in the notes. If you look at it, we were told depreciation is 50,000, and then amortization is 40,000. These were subtracted. So what do? We add them back. So depreciation and then amortization. And that is 50,000 and 40,000 respectively. We are going to add them back respectively. These has to be adjusted. So these are the adjustments we can do to the profit for the period. Then we can bring in movement in our working capital. So 82 minus 12 plus 100, literally, that's 170. Then we can bring in movement in the, working capital in that particular case. So we go in there and bring in movement in working capital. So you go to the current assets in the statement of financial position. What do we have? Inventory. What's going on with inventory here? This is the closing balance, the year end. This is the opening balance at the beginning. So you see that it has increased by 5,000. So when there is increase in inventory, money is going out. So you bring it here, increase in inventory. And that's 30,000 minus 25,000. That's 5,000. Money is going out because there is increase in inventory in that particular case. Then next one, trade receivables. We are seeing that trade receivables 26,000 at the beginning of the year, but it is now just 20,000. It means debtors are paying us. So a reduction in receivables is an inflow to us as an organization. So decrease in trade receivables. Decrease in trade receivables. That's 26,000 minus 20,000. And that is 6,000. Money is coming in because the people who owe us are now paying for how much they owe us. Next one, current liabilities. We will bring trade payables. What do we see here? We see that trade payables is going up. Now, when trade payables is going up, it means we are not paying our suppliers. So we are retaining that money to run the business or something like that. So increase in trade payables is an inflow for us as an organization. So increase in trade payables. And that's going to be an amount of 14 plus 14,000 minus 11,000. And that gives us an amount of 3,000. That gives us an amount of 3,000. And that's an inflow. That's an inflow. So that is all about the movement in the working capital of the company. So we do the workings and we get cash generated from operations. Cash generated from operations. And so when we do the maths on that, 170 minus 5, plus 9, and that is 174,000. Are you following the picture? Now you realize that when we're in the direct method, cash generated from operation is 174,000. Are you getting it? So irrespective of what is happening, we are going to be arriving at the same figure. But we bring in the interest paid and then the tax paid. Interest paid and then the income tax paid. So you realize that in this question, the interest paid is different from the charge for the year. Interest paid is 12, tax paid is 13. So 12,000 outflow, 13,000 outflow, and then we'll get a cash generated from operations. Sorry, net cash and net cash flow from operating activities. Net cash flow from operating activities. And so it will be the same figure as this one, 149,000. And you realize that in this question, the interest paid is 12,000, but the charge for the year, which is the finance cost, was 10,000. You see the thing? So that is how we present the cash flow statement from operating activities. Any questions, please? Any questions? So whether we are in the direct method or the indirect method, it will actually give us the same figure. But then the indirect method provides us with that realistic view of exactly what is going on in the adjustment to the profit or loss, in the movement in our working capital. Then we can know exactly what is going on for the period under review. So this is how we deal with the cash flow from operating activities. Any questions, please? I see some chats coming in. Let's see if I can take them. Cash received from, okay, I don't know what that is. How are you, Nhyira? I'm doing well. I have not joined this session for long. Okay. You are welcome. Good evening, Nhyira. I hope you're doing well. Watching from Tanzania. Good evening. Yes, I'm doing well. And thanks for joining us on the stream today. So that's the idea about the cash flow from operating activities. Okay, that's the so even though, like I said, the default way is the indirect method, the examiner can put a surprise on you. Then he'll give you an information that will help you to calculate cash flow from the direct method. So you just have to be on the lookout for the items that are supposed to be under the direct method if we are going in for that, and how we structure that out generally for the organization. How we structure that out generally for the organization. Any questions for me? Any questions for me? That's our cash flow from operating activities. So let's look at the rest of the items and then it will be good. Next one will be cash flow from investing activities. Cash flow from investing activities. Now, what I want you to take away from uh, investing activities is that it has to do with acquisition and disposals of assets. Okay, cash flow from investing activities has to do with acquisition and disposals of assets. That's what we're talking about here. We are looking at acquisition and disposal of assets. Now, when we say assets here, we mean both property, plant, and equipment. We mean investment properties. Okay. And we also mean financial asset as per IFRS 9. So all form of assets, their disposal, their acquisitions will be covered under the cash flow from investing activities. Also, if during the year the entity receives government grants, that is what will be brought here. The actual government grants received, not the one that was not the actual government grant received. Because sometimes in the question, the entity qualifies for a grant, but the government has not paid the money yet. You don't bring it if they have not paid it yet. But if it is actually been received and it is stated in the question categorically that a grant had been received, then in that case, we're going to be working ourselves out and most importantly, arriving at our figures. Let's have some ideas about how we arrive at those figures. What will we do if opening and closing expenses are given in question? When you say opening and closing expenses, what do you mean? I don't understand your question. You can contextualize that for me to know what exactly you're talking about as opening and closing. Any item that has more than one information on the face of the statement of financial position uh, means that you have to do workings for it. That is why, if you remember the interest, I told you that when you go on the statement of financial position and there is accruals of interest expenses in the statement of financial position, then you have to prepare the interest expense account so that you know how much interest that you actually paid during the year. So any item that has more than one information and has information in the statement of financial position, you may have to prepare account for it to know the actual payment or the actual receipts relating to that particular item for the year under review, so that you know the figure that must come in the cash flow statement. So let's go continue with the operating activities, sorry, financing activity. So what are a couple of things that are going to be captured here? One, acquisition of PPEs. Yeah, that's an outflow. So it's going to be there. Receipts from the sale of PPEs will be coming here. Payments to acquire shares or debentures in other entities. Be careful here. This is payments to acquire shares or debentures in other entities. So that is financial assets as per IFRS 9. Okay, like I told you earlier, we are acquiring shares in other entity or acquiring debenture instruments in other entities. Then we're going to be working out that receipts from the disposal of those investments will be brought here. Cash advances or loan made to other entities or other parties. If the entity also lends money to other parties, it's an investment. So it comes under investing activities. Cash receipt from repayment of advances or loan made to other parties. So the loan that we gave to people, they are repaying it. It will be brought here in that particular case. So these are some of the things that we capture under cash flow from investing activity. So, like I said, the key takeaway that I want you to have is what I illustrated here. That when we say cash flow from investing activities, our focus generally is about acquisition and disposal of PPEs, acquisition and disposals of investment properties, acquisition and disposals of financial assets as per IFRS 9, and then issues relating to the government grants that we have received as an entity for the year under review. These are the things that are going to be coming in when it comes to dealing with the investing activities. When it comes to dealing with the investing activities. Let's look at the last one, financing activities. The key takeaway on financing activities is that you are looking at movement in equity and non-current liabilities. So here we are looking at movement in equity and non-current liabilities. That's the financing activities. That's what we are looking out for here. What does that mean? It means that under the financing activities, you are going to be bringing in issues such as issue of shares. Okay, you're going to be bringing in issues relating to issue of loan notes. Now, how do you know there is issue of shares? You just look at the share capital on the face of the statement of financial position. If it has gone up, it means there was an issue of shares. How do you know if there is issue of loan notes? The same thing. If the loan figure has gone up, then it's going to be coming in that particular case. So the same thing happens. Repayment of loan notes is an outflow here. Will be an outflow here, or repurchases of shares, which is rare, but in case it is there, we will also uh, treat it as an outflow. Okay, then the capital repayment for leases. Okay, capital repayment for lease will also be brought. Now, be careful here because our focus is capital repayment. Our focus is capital repayment. Because you see, if you're a good student from IFRS 16 leases, we're going to be looking at that pretty later on. But if you're a good student of IFRS 16 leases, we can prepare the lease account. So lease obligation for the period under review. Now, remember the journal entry. In the PPE accounts, if you remember, we debited the PPE accounts with lease PPE. That is, if during the year they leased an asset. So you debit PPE with that, and then you go and credit this one. But then maybe there could be an opening balance. So you bring in the balance brought forward here. But remember, lease obligation will be divided into two. So there is current lease, current, and then what? Non-current. Going to bring all that up. Always lease obligation is divided into two. For those of you who have an idea about IFRS 16, if you don't have an idea, you can watch a video on that on the channel. We've made a video on IFRS 16, both the current and non-current. So we bring these up. Then maybe during the year we leased an asset. So lease PPE. What you debited to the PPE account will be brought here in that particular case. Then you balance the accounts. Then you balance the accounts. If you balance the account, the balancing figure will be the lease payments during the year. Okay, the lease payment during the year. But you have to be careful. This lease payment during the year includes two components. The interest component, which you will deal with in the P&L account, and then the capital element. It is the capital component that you are bringing in the financing activities. Okay, it is the capital component that you are bringing in financing activities. So when we say capital repayment for leases, it is the capital component that we bring in here. I'm seeing some comments coming in. Let's see, what do I have? Please, are fair value changes and fair value changes treated under adjustment? Are fair value changes and revaluation changes treated under the adjustment? Yes, it depends on the context of the question and what you are dealing with. For instance, as per IFRS 9, let me talk about that. As per IFRS 9, if we have a financial asset, there are two ways it could be carried. It could either be carried at fair value through P&L or at fair value through OCI. So where the financial asset is carried at fair value through P&L, then that means the fair value changes will be adjusted for in the P&L. So also when we are doing our cash flow statement, then we have to adjust that as well in the P&L account. Okay, so if it is a financial asset and there is that fair value movement in the financial asset, then certainly, because it's not part of our day-to-day activities as an organization, we have to adjust for it in the P&L account. So we will adjust for this in the P&L account in that particular case. Also, if there is a revaluation of assets, and like we mentioned, it's a revaluation loss, and it is the first time that we are having the revaluation loss, then certainly it will be treated for in the profit or loss account. So since it was treated in the profit or loss account, when we are preparing our cash flow statement, that has to be reversed in the adjustment for us to arrive at in that particular case. So that is the issue about treatment for rate. So to your question, please, are fair value adjustments and revaluation changes treated under the adjustment? Yes, it depends on the way the circumstance around for it to be treated. If it is a financial asset through P&L, then the fair value adjustment was done in the P&L. So in our cash flow from operating activities, we have to do the adjustment. If they revalue assets and it is a revaluation loss and it's the first time or it's an excess revaluation loss, then it will be recognized in the P&L accounts. So yes, we would have to make an adjustment to that in that particular case. So that is the idea about that. John, let me know if that it's clear for you in that. Then Mohammed said, John Bauer, the answer is no, 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 no. That is please, if there is a question and you don't have an absolute answer to it, don't write any answer down to confuse people, because your statement, it's not correct. If you understand the explanation I just gave, you realize that your statement is not correct. So if someone asks a question and you don't have a specific answer, please don't type any wrong thing in the chat to mislead people, so that we can really have uh, a real understanding on what we are studying. So let me go back to my leases. So when you prepare the lease accounts, you do workings for the leases, the balancing figure is going to be the lease payment. Okay. But like I mentioned, we are not going to be bringing that total amount. It's only the capital amount that we are going to pay. So what do? You bring in your lease payment from the workings that you just did. All right. Then you less the finance cost from it. The finance cost relating to the lease, which will always be in the P&L account, or the examiner will give it to you in the notes, so that your balancing figure will be the capital repayment of lease. That will be the capital repayment of lease. Are you getting it? So this capital repayment of lease is what you are bringing in cash flow from financing activity. Is what you are bringing in the cash flow from financing activity. So like I said, in cash flow from financing activities, you are looking at the movements that occurred in equity, the movement that occurred in the non-current assets for the period under review. So issue of shares, issue of loan notes, repayment of loan notes, repurchases of shares, capital repayment of leases. All these are items that are going to be included in the financing activities. So as you can see here, is the same thing that we have already mentioned or talked about, that we bring in the cash proceeds from issuing shares, cash payments to owners to acquire or redeem the entity shares, that is repurchases of shares, cash proceeds from issuing debentures. We've said that cash repayments for amounts that we have borrowed. In that case, cash repayments by a lease for the reduction of the outstanding liability relating to the finance lease. We've also spoken about that. These are the things that we must understand when it comes to preparation of the cash flow statement. When it comes to the preparation of the cash flow statement. Now, there are some additional workings that we would have to do in that case, especially for instance, like I told you, if you want to know about the issue of shares, you may have to use both the share capital and the share premium accounts to get the issue of shares situation coming in. The reason is that when we issue shares above the nominal value, the excess amount is recognized in the share premium account. All right. So, for instance, if we are seeing that share capital is going up, share premium is also going up, for us to get the figure for issue of shares, we have to look at the movement in the two accounts for the period under review. Okay. You have to look at the movement in the two accounts for the period under review. So, for instance, we may have the share capital account. Now, share capital keeps a credit balance. So, balance brought forward, we bring it here. You close the accounts up, balance carry down. You bring it here. You balance it up. The credit side will be more than the debit side, and that will be proceeds from the issue of shares. Or if you want issue of shares, that's all. And that's an inflow. Okay. But sometimes if the balancing figure is on the debit side, which is rare though, but it will be repurchases of shares and it's an outflow. To be an outflow. Repurchases of shares. So that is a rare case scenario. Okay. That's a rare case scenario. Then you look at a share premium account, the same idea. You look at a share premium account, the same idea. You look at the movement. So in the share premium account, the same thing. You bring in your opening balance. You close the account and get a closing balance. The balancing figure will be issue of shares, which will be on the credit side. So for you to get proceeds from the issue of shares, okay, proceeds from the issue of shares, you add the balancing figure from the share capital to the balancing figure from the share premium account. The two will give you proceeds from the issue of shares. The two will give you proceeds from the issue of shares. And that is what you must understand when we talk about getting your figure for the issue of shares. So these are a number of workings that we need to understand in relation to dealing with issue of shares in that particular case. Any questions for me, please? Any other questions for me? Let me know. You put it in the chat for me, or you put it in the comments section for me to look at for you. Israel Som, Nigel Kalonde, Amanda Chikura, Eric Ahiadeki, Rashid, and then Salifu Fusaini. Thank you for the thumbs up on the video for us on Facebook, and also for those of you guys on YouTube. Thank you very much on that particular one as well. Let's see. Any other questions for me? Now, we've received, or we've been receiving, a couple of other questions relating to the fact that whether we are doing intervention class. I think I mentioned this on Monday. We don't do intervention class here as our institution, because as per our business module and our mission, we don't believe in using one or two sessions and doing something and letting people go and write exams. That doesn't make us wrong. That doesn't make someone else's also wrong or right. It's just our belief system and the way we run our programs here. So we don't do intervention classes. Our lectures our practice question sessions, our executive revision masterclass, all these are exclusive to our students. So we don't do intervention. And so the only way that you can be part of our community, join our executive revision masterclass, get access to our examination analysis documents, is to actually enroll and be part of the entire programs, because that is what we believe in, and that is how we run things here. So we don't do intervention. We've had a couple of messages even today from people asking, when are we doing intervention class? We don't do intervention classes. We don't do, because like I said, that is against what we believe in and what we look for in terms of how this program has to be done, because it's not just about going into the exam hall and pass, and it's not just about crunching things within 1 or 2 sessions and saying voila, go and write exams. No, you need to go through the entire trenches, be part of the sessions, do assignments, do performance evaluation tests, be part of the practice question session, be part of the executive revision masterclass, go through the mock sessions. All of these will prepare you well, not just for the exams to pass the exams, but most importantly, so that after your studies, you can also have a practical application to the things in that case. So that's why we don't do intervention class. And so please take note of that, because like I said, we've been having a couple of messages coming in from that. John said, so revaluation gain and remeasurement gain that affect OCI are not considered in cash flows. I think we discussed this issue. Revaluation gain is considered in cash flow if you are preparing the PPE account. If you remember, we mentioned that when we're looking at the PPE accounts. We mentioned that if you're looking at the PPE account, in case you missed some of the sessions or something like that, you can watch the playback and then you will understand what is going on. Because when there is revaluation of assets, which is in the OCI, it will be reflected in the PPA account, which will help us to either calculate our depreciation or calculate the disposal of PPEs or calculate the acquisition of PPE for the period under review. So revaluation of assets and even deferred tax also, which is in the OCI, all these items have an implication in the cash flow statement. If you remember, when we're preparing the tax account here, I told you that the tax charge for the year, okay, will be both what is in the P&L and what is in the OCI. So, like I said, in case you missed the part one, you can go back, watch the part one so that you can understand some of these things very well. Because OCI, a lot of things that will be recognized in OCI have cash flow implications, either in the operating activities, the investing activities, or possibly the financing activities that we must know about. So they are considered in cash flow if you ask. Echi Gertrude said, thank you. I really understand this cash flow statement. All right, that's fine to hear. So that is the principles, that is the idea about the cash flow statement. For time constraint purposes, I will not be able to take a fully fledged cash flow question today. So God willing, Friday, I'll be coming your way, same time at 4:30 p.m. And then we'll take some practice questions and look at how we can prepare a whole cash flow statement, the various workings that we need to do for the cash flow statement, and also to help us to really increase our chances to be able to pass the examination when it comes to the cash flow statement. So that is what you must understand when we deal with cash flow statement. And I'm going to be concluding around here today. And God willing, Friday, I'll come your way with one practice question like that in that particular case. So if you look at what we have gone through just in cash flow statement, you realize that you need to spend time with the subject. Are you getting it? Look at what we've gone through in just cash flow statement. You need to spend time with a subject. You cannot fast track financial reporting. You cannot just sit down and get up and attend 2 or 3 classes or do some shabo shabo 1 week and think you will go and pass the exams. It won't happen like that, because you need to understand everything well, practice enough questions, and ensure that when questions are put before you, you will be able to understand it. And if you realize in our discussion about cash flow statement, the accounting standards are coming in. IAS 16, it's in town. IFRS 16, it's in town. IAS 2, inventories, is going to be in town. Issues relating to IFRS 9, financial instruments, is going to be in town. Issues about impairments, IAS 36, is going to be in town. Issues about IAS 38, intangible assets, will be in town. Even provisions can be in town, IAS 37. So the standards are the core, are the bedrock. That is why I always tell you, don't sit down 1 week to the exams, 3 days to the exams, and try to do some magics. You will go and fail the exams. You will fail the exams. And every semester, we see the uh, average pass mark at the end of the day, or the pass rate at the end of the day from the examiner's from the examiner's report. So don't sit down and get some ideas into your head thinking that you can use 1 week or 3 days to go through and go and pass the exams. No, you will punish yourself. That is why it is our belief that you must go through the trenches, go through the meal very well, be prepared very well, solve enough questions, put yourself in that spot that you'll be adequately prepared for the examination. And that's how you win. That's how you win. If you want to understand the things, then you need to take your time and go through them very well. That is the only way. There is no fast food in financial reporting or in ICA or in ACCA. It's either you know it or you don't know it. And you will feel miserable when you come from the exam hall and you are not able to do what you're supposed to do. Very, very miserable. Very, very miserable. And that is where you hear a lot of people saying that, oh, the ICA exams is difficult. No matter what you do, you will fail the exams. When I hear some of those things, I realize that that is foolishness. Because the exams that he said is difficult, someone passed. The ICA that he said is difficult, someone scored a best student in that exams. So why was it difficult to you? Because you thought you could fast track your learning and just whisk yourself and go and pass the exams. It doesn't happen that way. Why am I saying this? We have 4 weeks to go for the August 2022 examination. If you are going to write these exams, you need to up your game. You need to start studying. You need to start being serious. In the next 4 weeks, you can cause a lot of damages. You can cause a lot of damages. And if you do that, I can guarantee you that you will pass the exams. But if you sit down 1 week to the exams, 3 days to the exams, and try to do some shabo, you will have emotional trauma, go to the exam hall, have a lot of migraine and headache, come from the exam hall, fall sick and go to the hospital. Your results will come, then you fail on top of it. Then you realize how miserable you are going to feel. So if you want to avoid all that, start working now. 4 weeks to go, you can do a lot within the 4 weeks. So that is what you must understand. And that is what we expected you to do at the end of the day. So I'll catch you same time on Friday as we take a question on cash flow statements and see how practical some of the standards will be shining when we are dealing with cash flow statements, so that we can now bring to bear all of these principles that we have discussed over the last 2 sessions. So that's it about that. Take care of yourself, and I'll catch you same time on Friday as we continue with our discussion. Bye bye.